welcome back to MMG. So today let's talk about the Big Short. Before I get into that, let's talk about today because there was a lot of news. Well, not a lot of news, but it seemed like it because Trump's tweeting away. Everyone's excited. Jobs numbers, payrolls, everything is the best. The economy's the best it's ever. Uh, I think it's really going to backfire in 2020 for Trump. Uh, will he make it? I don't know. Maybe. We'll see. Probably. Because I don't really see any candidate who's. I mean, the market's not going to. They can't let any other candidate because the entire economy would just implode. But it's still gonna happen on his. It's still gonna. I think it's still gonna happen in 2020, even though we're printing the best jobs numbers ever and blah blah blah. So let's talk about that before I get into the Big Short and look at a few charts, this and that. So here's the economic calendar. So average hourly earnings year over year beat estimates. It's 3.1%. Forecast was 3%. Previous was 3.2% for 2018, so it's a little bit lower. Average hourly earnings month over month for November is actually negative. It didn't even beat forecast, which was 0.3%. It was 0.2%, so that's not that great, but, you know, we're going to look at Trump's tweets in a second. Average weekly hours, 34. It hit forecasts or estimates. Government payrolls are up. That's not good for the economy because they don't actually grow the economy. They take from it. Manufacturing payrolls. This is important for November. 54,000. Forecast was 38,000. So they really beat estimates. Last month was negative 43,000. Schiff tweeted out that they added the GM workers going back to work possibly. I don't know. But listen, these are all gonna get. They're going to go back and readjust these numbers like in a few months or half a year or something like that to lower. I guarantee you. Non-farm payrolls. This is the big one. This is what everyone looks at. And if this is good, you know, market goes higher. 266,000. Forecast was 186,000. That's huge. Huge gap. Last one was at 156. So how all of a sudden did we create so many jobs? Listen, I wouldn't be surprised if Mnuchin has like a team, like a whole like level to a building, and they're like all orchestrating all this. They're like, all right, like they're all talking to each other. Like, all right, Fed, you guys come out with some good numbers. We'll do some market orders. And then Trump will do a follow-up with a bunch of tweets. That'll get the algos going. And then the market's just going to rip higher. And then the retail investors are going to see this eventually. And they're going to go shopping. And then they're going to buy some more stocks. And then everything's just going to go higher. And everything's going to be okay, right? It's pretty funny. I like wouldn't be surprised they're doing shit like that behind the scenes. I don't know. Participation rate 63%. I think since the last dump in the markets at the beginning of 2019 and the end of 2018, how the markets fell like 20%. I think that scared them so much. They're like, we need to do whatever it takes to keep the market going higher and higher, which is, you know, manipulation, and that always ends well. I'm being sarcastic. And that's pretty much it that I wanted to cover on that. So let's take a look at some of these tweets, right? And look at the market. Just ripped higher. You guys have to understand, the higher the market goes, the more money it takes for the market to go higher because the market cap keeps growing. So a 1% gain when the markets are at all-time highs is 10 times harder to get from when the market was at its all-time lows because it takes 100 times more money to make the market cap go higher and larger and the percentage gains to go higher. It just takes more money. That's why they already had to, lower rates, and they're doing the repo, not QE in the background. So, all right, let's, I just want to look at the Zero Hedge article. This is a nice chart. So, has QE4 begun the 1.2 trillion per month hole in the repo market? So I wish I saw this article for my last video when I was covering the repo. You should watch that if you haven't. In the 2 months since the repo market blew up, the Fed has been making repo open market operations purchases at a rate of 1.2 trillion per month. It's worse than I even thought. Like the calculations I was making wasn't even as bad as it really is. I just I couldn't go that far back in the history. I didn't want to. I only looked at 3 weeks, which was almost $1 trillion. So if you look at 4 weeks, it's 1.2 trillion, which is insane. It's absolute. You can't fathom the amount of money that is. Now listen, these repos, they mature, right? And then the money goes back to the Fed. It's not like the banks just keep the loans. They do pay it back with interest, or with probably damn near zero interest for the Fed. Below is the monthly rate of Fed open market purchases since 2000 in the era of QE and the ample reserve. The Fed has not touched open market operations for more than 10 years, before 2019. Prior to that, the highest rate of open market operations we saw in history was roughly 300 billion per month, briefly after the September 11 attacks, with the long-term averages around 50 billion a month. To say the current rate of 1.2 trillion per month is unprecedented would be an understatement. So look at this. Look at this chart. So this was right after the financial crisis, right? They stopped doing repo because they were doing QE. That's why they haven't been doing repo. So they didn't do anything with repo for the past 10 years, since 2009, since the financial crisis. But that is because they were injecting money straight up into the system and the banks. So there was no need to do repo because they were doing QE, which is just, they make money out of thin air and then inject it into the banks and the market. And then as of late, a few months ago, after they were raising rates at the beginning of this year and the end of 2018, they stopped raising rates because it kind of pricked their own bubble. That's why the stock market fell 20%. And then, they started cutting rates, but the problem was they pricked their own bubble. Something broke. Some bank went under, whatever. I don't know. Nobody does yet. We will find out eventually. And the banks won't lend to each other. They know something is up. JP Morgan, remember, they stopped doing overnight repos, and they were the biggest whale in the pool that was doing that bank wise, and they just went and bought 30-year bonds. They're like, let's just take our cash and put it in the 30-year bonds to gain yield on that, rather than lending out short term, day over day or whatever, week over week, the repo market to other banks. So they don't think it's a smart idea, because probably they know that some banks are in trouble or something happened, right? So then the Fed has to come in and do the overnight purchase, loans. The planned QE unwinding has hit a brick wall, and the Fed balance sheet is now expanding at a rate matched only briefly by QE1 and faster than QE2 or QE3. So this is the irony, right? Powell says it's not QE. Okay, then why is the balance sheet growing? And here's the thing. you could say that the balance sheet will grow temporarily as they do the repo. Okay. But is it going to be temporary? I doubt it. And it's growing and growing at a faster pace, meaning this isn't temporary. Okay. In my last video, I showed you guys it was at 4.1 trillion, and the highest it ever was 4.5. I mean, it's not that far off from, you know what I'm saying? Especially if it's 1.2 trillion monthly that they're doing the repos. So, I mean, you can see it on this graph. Monthly change in Fed balance sheet shoots up like a rocket. This is the canary in the coal mine, guys. This is the canary in the coal mine. I'm on record for saying that. This is it. This is signaling the SHTF is going to happen probably soon. Like, and what I mean by soon is, I'm telling you 2020. Is this temporary rescue of the repo market or the start of a sustained QE4? To answer the question, we must look at how monetary policy is involved in the financial crisis. Pre-2008, scarce reserves regime. Total reserves small, 50 billion. Excess reserves none. Interest on excess. So I'll post this in the newsroom and you guys can look through all of that, all right? I don't want to make this too long of a video. So I'll post this after my video in the newsroom. Links below the video in the description section. The free newsroom, right, guys? All right, let's get to the twats. So here's my Twitter account. I'm not showing you guys my Instagram account because I'm locked out of it. You could still look at my Instagram account, and the last picture I post, that's why they locked me out of it. Apparently that is... So it's funny because it just shows how true it is. You guys could go look at that. I don't even want to talk about it. So let's look at Trump's tweets. The bestest ever. I'm the best. I mean, that's his marketing strategy, right? All right. So the one thing is, here's one thing he says. Stock market's up record numbers for this year alone. Dow up 18.6%, S&P up 24.3%, NASDAQ composite up 29%. It's the economy, stupid. He's referring to, that's, I think that was Clinton's quote. That's how he won an election, right? The stock market isn't the economy. Well, this is my reply. The stock market isn't the economy. Well, it is not supposed to be, and that is the problem. Where do you think the inflation is hiding? And like I say, guys, the real economy is not the stock market. The stock market is a byproduct of the economy, yes. The problem is, now the stock market is leading the economy because our economy isn't based off of manufacturing anymore and building shit and exporting it. It's basically based off of financial engineering and the financials and Wall Street and the stock market and debt. That's what happens. That's what happens when you have central banks. They destroy the real economy, replace it with a financialization of it, which is technically a Ponzi scheme. And I'm going to get a little more into that as I talk about CLOs and all that. Nothing is real. That's what I wrote here. This is a blowout. Look at these manufacturing numbers. A blowout. Oh, my God. Yeah, this is the first time manufacturing looks good. But the ISM is falling. All right, Fed balance sheet moves up to 4.07 trillion, highest level. Yeah, and I talked about that in my last video. I wonder if this guy watched my video. That'd be cool. I don't think too many important people watch me. Maybe they do. That'd be cool. Probably not. I'm not that professional. I'm not professional, guys, whatsoever. All right, so how are we going to keep these jobs numbers strong going forward? I've got an idea. This is actually a good idea. I'm not going to lie. Nearly 700,000 will lose food stamps with USDA work requirement change. That's funny. Well, you got to get the animals off the dole because there's signs in the parks, right? Don't feed the animals because then they can't fend for themselves because they become lazy and dependent on you giving them handouts, right? Food to survive. And then they don't know how to hunt or whatever. So in like wildlife refuges, or when you go to like Yellowstone Park, these wildlife areas, you're not supposed to feed the animals because if you do, then they won't know how to hunt. And same goes with humans. If they get free food and housing and all this crap, they're not going to get a job. And then they lose skills and they don't learn anything. And then they're just there, becoming like parasites upon the productive members of society, right? And then they go and vote for the lefties. I digress. All right. Now I can get behind this. Trump expresses frustration about water efficiency. Says sinks don't have enough pressure and people have to flush toilets multiple times. You know what? I totally agree. I could get behind that. I mean, toilets. Most of them don't have enough pressure, and I eat a lot because I work out. I'm all about the gains, not just financial but muscle. So here's a nice chart. Since the Fed started repos and not QE, the market is up every week. The Fed's balance sheet is up. It's down when the balance sheet is down. That's kind of funny. Yeah, let's keep monitoring this because that's hilarious. And it, the longer this goes and the more correlation you see between the two, yeah, eventually they're gonna lose. Eventually, the Fed will no longer cease to exist if everyone catches on to that. If that's true, if that's what happens, which is true, that's pretty much what happened. What they're entailing is like the money from the repos is going into the markets and everywhere else, which is probably what's happening. That's why it's QE. Kramer. Look at this. You just watch that. It's funny. But anyways, so what I'm saying is it full-time or part-time jobs that are being created? I think it's more part-time jobs if you look at the U6 unemployment and all that. Just like it was for the last term for Obama and whatnot. So, do people need more jobs to stay afloat? Are people like working 2 part-time jobs, 3? I don't know. You guys let me know. I guarantee you there are some good full-time jobs also being made though. Because it's still an expansion period and the markets keep going higher. So corporations make stupid decisions and they hire more people. And so do small businesses and mid-sized businesses. They all hire more people as the stock market goes higher. It's a wealth effect. Psychologically, they think everything's going to be great. That's why when the SHTF happens, it happens fast and hard. Like it blindsides people. Everyone's like, whoa, wait. Like within 2 months, everyone's like, what's happening? And then all of a sudden, everyone's laying off all at once. Hedge funds versus the S&P 500. So hedge funds research equity hedge index. Yeah, hedge funds are not doing as good as the S&P 500, which makes me question who's buying the S&P if they're not, because they're unloading. Hedge funds have been unloading the indexes and indices. Besides pensions and your retail investor with their 401k IRAs and whatnot, maybe some foreign investors are, and who knows? Maybe who is buying all of this? Where is all that cheap money going? And who? The banks? I don't know. We're gonna find out eventually in our lifetimes. So This is funny. This stuff kind of makes me mad though. So a banana duct taped to the wall sold for 120,000. Okay, there's a couple things wrong with this. One, that's not art. So when on auction, that's not art, in my opinion. That's what is that? It's a banana duct taped to the wall. And two, I mean, so let's say you're dumb and you think that's art. It's gonna rot, right? It's gonna rot. Like, so your art isn't even gonna be worth anything because the banana will rot, or maybe just the peel was. I don't know. Anyways, all I said was there's no access. So that's what Powell says during his hearings. I don't see any access in the market. Are you shitting me? People are buying bananas duct taped to the wall for 120,000. If that's not access, I don't know what is. So yeah, one of the best ways to what the rich do. People wonder why they always buy collectibles like cars and art, stuff like that. It's because it's a way for them to keep their money from depreciating. It's a way to sort of circumvent taxes and because these auctions are always charitable, right? So it's a write-off. It's actually a write-off, and they buy fine art for a banana duct taped to a wall for 120,000. But and then they plan on selling it to some other rich guy, later on for more, and it's like I don't want to say it's to laundering, but they do that as well with art. And you could always take art and transfer it all around the world, and then sell it somewhere else, right? There's a lot of not kickbacks, but it's very sneaky, but art is like the number one way to for the super wealthy to move capital around, right? And circumvent things. Just saying. I have a story, but I can't say it. It's kind of funny. I did it in college when I was young. I want to share it, but it's public. All right, here's the yield curve bonds. The 10-year here's the yield curve. All right. So the Fed needs to get the short interest down. They're going to go to zero eventually. And then the yield curve is going to look steepened again, which will be normal. Now, if this end of the yield curve, the shorter bonds, right, with the smaller interest, these bonds, if they start rising again above the longer term bonds with the longer term maturity, then you get an inverted yield curve. So it looks like that, right? It'll look like a cup or something, a bowl. So what the Fed needs to do is keep the short interest down. That's why they keep cutting rates. And it's going to pull down, the 1 year, the 2 year, the 3 year, the 5 year, and even the 7 and the 10. Eventually, it's going to pull it down with it. And that's why JP Morgan bought the 30 year, because that's going to stay high above 2%, which will be not running higher than inflation, but, it's better than short term. So they're going to do that, right? But eventually the market, at some point, I don't know when, guys. It could be years from now or a few months or probably a couple years. At some point, interest rates are going to explode to the upside and the bond market's going to blow up. Bonds have been in a bull market for 3 decades. That's going to come to an end sometime, I think, within 3 years or 5. And that's a big statement. No one's willing to say that. I think something like that's going to happen. That's just my opinion, not financial advice. I'm just saying. I wouldn't be surprised if that happens. Or can they do the Japanification thing, where they just keep the yields, normal and not normal, but it's steepened, and they just keep printing, and we get stagflation for decades. I don't know. So that statement I made earlier about the bond market blowing up, I think that's going to happen. It should happen. Can they somehow keep it from happening and we end up like Japan? I don't know. Maybe. I don't know. I doubt it because there's too much debt. That's the problem. There's just too much debt. And Japan's gonna, and then there's no one to bail out the U.S. Like there's, Japan sort of was bailed out by the rest of the world, right? The rest of the world's growth. Well, we're all in this Titanic together. If you haven't watched my Titanic documentary video, you should watch that. Anyways, so I just wanted to touch base on this again. So, here's the Fed funds rate, the interest rate, right? You can see it's been pulling back as of late. This is from 1981. This is when Volcker raised interest rates because there was huge inflation and lines at the gas pumps in the 70s. Back then, we were able to do it because the U.S. still had a huge manufacturing base and the economy was much stronger, and there wasn't that much debt. All right, let's go to a 1 year. See how much this has dropped. See, so we made it up, to about 2.5%. Right now we're sitting below 1.8, around 1.7% on the Fed interest rate. So Gundelock came out and he said, I think the next recession won't be anything like the housing crisis. I think it'll be a corporate debt problem and an interest rate manipulation solution. Right. I mean, they're already doing the interest rate manipulation. And I agree. Now, The Big Short, right? If you guys haven't watched the movie, watch it. The Big Short. It's pretty good. I think it's my favorite out of the financial, movies. It really, yeah, it's my favorite, definitely. But where was I going with this? Okay, so the guy from The Big Short, the guy drumming, what's his name? Played him, that actor. I forgot his name. I forgot. Anyways, you guys know who I'm talking about. He was on CNBC like a few weeks back saying that the next Big Short is Deutsche Bank and all that, which is, that was The Big Short a few years ago, like a year ago, a couple years ago. It's so low, and he says it's gonna go to zero. I don't know, because they're gonna get bailed out nonstop. I don't know. I don't like shorting because shorting is extremely risky and dangerous. All right. But I don't think that's the Big Short. I mean, banks are going to not do well. Yeah. Some are probably going to go out. But what the Big Short I think is CLOs. Collateralized loan obligations. Just like the mortgage-backed securities. What are CLOs? I'm talking about CLOs for corporate debt. Now, you guys, I'm going to post this in the newsroom. What's her name? Danielle D. Martina Booth from The Real Vision. It actually came out behind the paywall early. They just made this video on the 4th, so 2 days ago. I just watched it. It's pretty good. I'll post that in the newsroom, all right? So, what were they talking about? You guys should watch that. And I'm just going to give you guys a quick brief on it. Brief. All right. So, all the negative interest rates for, well, not negative, but near zero, ZERP, right? Or NERP. For the past 10 years, since the since the financial crisis of 2009, Feds had artificially low interest rate and they kept, doing QE. And everyone's searching for yield. It was hard to search for yield. Although, everyone keeps saying that, but the stock market just went straight up. Anyways, well, nominally, I guess versus inflation. But, people are searching for yields. Funds are searching for yields because you can't get it with bonds. You're not going to get a yield. You can't get it with CDs. And people are searching for yield. Like, yield as in a constant interest payment every year over year, right? That's more secure than volatile stocks. Okay. So, pension funds do this, hedge funds, retirement account, all of that. Endowments, you name it. So, a lot of people saw corporate debt yielding a decent amount, so everyone started piling into corporate debt. This market used to be very small, but in the past 10 years, it's grown to be huge, trillions and trillions. I forgot the exact number. I think it's around 13 trillion in corporate debt. It's been issued. That's a lot. It's like it's like 40% of the U.S. economy. So, why is this a huge issue? Well, for one, these corporations really haven't been investing all that much. The big ones, they have been investing. It's just they've been doing a lot of corporate buybacks. Now, where's that money coming from? It doesn't just come from revenue. It doesn't just come from... it comes from taking out loans, right? Issuing corporate debt. So they issue corporate bonds, and people and funds and whatever buy them. Institutions, banks even, right? They buy these corporate bonds, and then they yield an interest. And then the problem is when this expansion is over with, right? And you could see it that the unicorns, WeWork, Uber, Lyft, all these new IPOs that have come out, their balance sheet, no one was looking at their balance sheets. None of these companies were making profits whatsoever. There's a lot of companies that have IPO'd recently, and there's a lot of companies right now that just don't make a profit, but their stocks keep going higher. And investors have been ignoring balance sheets and profits. All they look at is EBITDA, right? And all they look at is revenues and shares per earnings. But they don't look at profit margins. And the problem is, once the expansion cycle is over with, they're going to start looking at that. And now with the recent blow up with WeWork and all these IPOs and unicorns, as their stocks have been plummeting, people are starting to look, the risk on is coming off now. And people are going to start actually looking at reality again, meaning instead of just throwing money in index funds and just chilling and relaxing and watching the market go higher, they have to start paying attention to balance sheets and actual profit margins. And they're going to see that a lot of these companies, they're not as healthy as they really look on the outside. And, their price to earnings ratios are insane. And that's because of their own buybacks that that they've been doing after they issue corporate debt. So what I'm trying to say is, high debt versus EBITDA, right? So EBITDA, what's that? It's earnings before interest, taxes, depreciation, and amortization, which is loans. All right. And they have to look at the debt versus all of that. So it's not just earnings and all. They can't just look at EBITDA and PE ratios. And when they do that, they're going to find out that these companies are in trouble because they've taken on too much debt. And then people are going to start taking profits from holding these CLOs, these corporate bonds, right? And once that cycle comes to an end, because everything's a cycle, the bond market, so these tranches of AA rated, BB, and Cs, they're going to start pancaking and falling, just like the mortgage-backed securities did. And if you want a good example of that, go watch The Big Short. Remember when that one guy took the Chinga game? You know what Chinga is? the blocks where you take you try to take out a block without it collapsing. Well, he did that, right? And then he kept taking out blocks and then it finally collapsed. So it's kind of like that. That's what pretty much happened to the mortgage-backed security. Same thing is going to happen to these corporate bonds. And these idiots were buying their own stocks at all-time highs. So those are going to plummet as well. And then it's kind of like it wipes itself out. That's why I keep saying everything's a Ponzi scheme, because of central bank, money expansion, credit. You could have credit expansion, guys. It's actually good to have it to grow an economy. The problem is you have to have some stable backing of the currency, because if you don't, you just have endless credit expansion, and then you get stupid things like WeWork and all these corporations that don't make a profit, but their stocks and market caps keep going higher because of risk and speculators making money and nobody caring about the fundamentals, and no one's doing value investing Warren Buffett style anymore. It's just all algos, indexes, ETFs, and speculators. It's a giant circus, and when the music stops, and I think it's going to stop soon because everyone's ignoring the debt until one day something's a black swan, something's going to happen, right? Again, the repo market, something broke, okay? So there's already signs of it. So let's look at some charts. Corporate debt rising versus GDP. So corporate debt has surpassed GDP growth, of course. Corporate debt is, it's up there, right? 46%, that's crazy. 46% of GDP, that's insane. Debt coverage, bond issuers, basis. This is 2018, third quarter. Just look at this chart. I just want you to see a visual of it just skyrocketing. And this is for so this is corporate debt for everything. It's not just retailers, it's utilities, transport, real estate, mining, infrastructure, machinery, oil, gas. Moody's season BAA yield less bank prime rate, basis points inverted. So investment grade corporate bond ETF. So there's ETFs now that track the corporate bonds. Just derivatives upon derivatives upon derivatives. It's just, it's wild. This is June 2019. Hit at all-time highs in June. The size of corporate debt on rung above junk has never been greater. So your blue is your triple A. That's the highest. It's up here. There's more triple A than anything. And then double A is your red. Orange is just your A rated. And then your triple B is this gray right here. And then black is double B. And then your orange is your triple C and below. But I guarantee you all these could get downgraded. A triple. I mean, listen, guys. This is how mortgage-backed securities were graded as well. They were graded. They looked just like this, sort of, back in the day, right? Of like 2006 or 7. Non-financial corporate debt as percentage of GDP exceeds prior peak. Right. This is the same thing except the bar chart that I showed earlier. Nuts. This is 2018, September 30. It's old. I don't have, new data. I'm just looking up charts. U.S. corporate debt to GDP ratio. Yeah. It's near 47%. Well, this was 2018. It's probably higher now. Or maybe it's around there. All right. Effective federal funds rate. And then capacity utilization manufacturing. I don't know. I just want to show this chart. This is the blue line is your manufacturing, and then your federal funds rate, right? So, as the manufacturing base slowly in the past few decades has fallen, the lowered federal funds rate has still helped the manufacturing base of the U.S. But imagine if rates were normal or higher. Where would the manufacturing base be for the U.S.? Because it can't compete on a global level because, regulations and, they just can't compete. There's less regulations and standards and EPA and all that in other countries where they don't care. Of course, other countries like China, it's managed. The government there just prints money like crazy, and they help the industrial section grow for the country. It's good strategy, but it's not a free market. That's why they have some of the biggest bubbles. Their debt to GDP is like 300% in China. It's insane. They're worse than the U.S., but it's gonna be bad for the U.S. as well once this credit expansion cycle just finally comes to an end. So let's take a look at this. I posted this in the private group. This is what I'm expecting for the next few weeks and months. All right. The green line is the S&P 500. The orange line, can you guys see that? The orange line is gold. And the blue line is the 10-year yield. Now, I expect the yield to keep dropping because they have to drop it to keep the party going, or they're going to have to drop it because the market's finally going to correct in a big way. It has to at some point. Now, can they keep pushing the market higher? I really hope not. Listen, guys, they're pulling out all the stops right now because it's the biggest shopping season of the year. They have to keep juicing the market higher. The higher they juice it, though, we're going to get a blow off top. So I think first quarter at some point in 2020, we're going to get that correction if we don't get it in the next 3 weeks. All right. That's what I believe, not financial advice. Could be completely wrong. So this is what I'm looking at. This is what I want to see. I want to see the 10-year yield drop. I want to see gold rebound back up to the upside, and then the S&P pulls back. All right, on these line charts. And this is a 3-day chart. That's what I want to see happen. And I think that's going to happen because they need to get the 10-year lower. And even if the market goes a little higher, that doesn't mean that gold can't rise with the market because it's been doing that all year. So I want to see that. So that's what I'm hoping for, all right? You know what? I'm not going to go through charts, any more charts. I had a bunch of charts open, but I don't want to make this video like 5 hours long. I'll do another TA video before the markets open on Monday. All right, guys. Smash some likes. Leave anything in the comment section. Share my videos. It's the only way my channel grows. And I'll see you guys in the chat groups. Till next time.